A discussion of central bank operations and interest rate policy by Warren Mosler and Phil Armstrong. The long-term risk-free rate. The yield curve shows the risk-free interest rate for government debt of different maturities and acts as a benchmark for other debt. In the current situation in the UK and US, for example, the central bank sets the overnight rate and allows market forces to determine the long-term rate structure. The state, via its central bank, could directly set the entire term structure of risk-free rates, also known as the yield curve. The Bank of Japan is now doing this for its 10-year bonds, for example. Operationally, the central bank stands by to purchase unlimited quantities of government debt at a price consistent with its interest rate ceiling target at each maturity level, and sell securities to support its lower boundary. Mosler, 2012. Central banks also intervene selectively when they wish to influence, rather than peg, longer-term interest rates. Quantitative easing, or asset purchases, using Bank of England terminology, was meant to increase demand for government bonds, raise bond prices, and reduce bond yields. The policy was enacted in the expectation that these lower bond yields would boost investment and also increase demand for alternative assets, such as equities. The extensive purchase of securities led to a significant expansion of central bank balance sheets and an explosion of bank reserves. This point was noted by Keister and McAndrews, 2009, and is illustrated by the Federal Reserve Statistical Release H 4.1 below. A standard upward sloping yield curve reflects an expectation of rising interest rates on the part of bond dealers. Footnote 8. Potential buyers of bonds will consider possible future central bank interest rate settings, along with default risk should that be a consideration, and in general, prices will reflect those expectations. End footnote. Investor expectations of bond yields and yields in the future are continuously reflected in the yield curve adjusting to indifference levels. This includes preferences for cash, long-term securities, or long-term securities. Furthermore, as we have noted, any such effect results from an active choice on the part of the state or its central bank to cede power to financial markets in determining the spectrum of long-term interest rates, as the term structure of rates merely expresses anticipated central bank interest rate changes.